While everyone was chasing AI stocks, one forgotten corner of the market delivered returns over 1,500% in just 5 years. This wasn't some meme stock or crypto pump, it was the quiet, methodical world of value investing, specifically in Spain, and led by a man nicknamed the Spanish Warren Buffett. In a market obsessed with growth at any cost, how did a strategy that felt boring suddenly become a goldmine? We're going to break down the exact investments Francisco Garcia Perums made, the companies he bought, and why his firm, Cobus Asset Management, saw these explosive gains when much of the S&P 500 was barely keeping pace. It's a masterclass in patience and contrarian thinking, and by the end, you'll see the often overlooked cost of chasing fads versus sticking to fundamentals, a cost that determines your long-term success. In 2026, while the S&P 500 largely consolidated AI gains, one overlooked strategy delivered a massive 45% return for a small group of value investors, all thanks to the Spanish stock market. This wasn't some meme stock frenzy, it was a methodical, Benjamin Graham-style approach, championed by figures like Francisco Garcia Perums, often called Spain's Warren Buffett. Perums, a deep value advocate, saw what many missed: a compelling disconnect between the true earning power of certain Spanish companies and their beaten-down stock prices. He observed that these companies, often in traditional sectors like infrastructure and energy, were trading at price-to-earnings ratios as low as 8x, while their European peers commanded 15x or more. This wasn't about finding the next Nvidia. It was about finding solid businesses, often with robust balance sheets and consistent dividends, that the market had simply forgotten. We're going to dig into the exact companies Perums and his peers invested in, what specific financial metrics they prioritized, and how their patience paid off with returns that significantly outpaced broader market indices in 2026. This matters because it highlights that even in a fast-paced market, the foundational principles of value investing can still deliver substantial alpha for those who are willing to look where others aren't. But how did an entire market get so overlooked that a specific strategy could deliver such outsized returns? Before 2026, Spain's stock market was largely ignored by international investors, often seen as a laggard compared to European powerhouses like Germany or France. The IBEX 35, Spain's benchmark index, really struggled with a perception of slow growth and high public debt, discouraging broad investment. Analysts often pointed to a PE ratio for the IBEX 35 that was consistently 15 to 20% below the broader Euro Stoxx 50 average between 2018 and 2023. This created a ghost market, where many Spanish companies were trading at significant discounts to their intrinsic value, a classic signal for deep value hunters. The prevailing narrative of old economy sectors like construction and banking really overshadowed the potential for turnaround stories, creating a thick veil of pessimism. For example, Iberdrola, a global leader in renewable energy with operations across the US and Latin America, was consistently trading at a PE multiple lower than its European utility peers like Italy's Enel, purely due to a perceived Spain discount. Even as late as 2022, you could find Iberdrola trading at around 12x earnings, while Enel was closer to 15x, despite similar growth trajectories. The lesson here is that market sentiment can significantly disconnect a company's stock price from its underlying business fundamentals. This kind of widespread pessimism, while uncomfortable for existing investors, is precisely what creates opportunity for those willing to look beyond the headlines. So, what was the actual catalyst that started to chip away at this skepticism? But what truly flipped the script was the staggering €140 billion in EU next-generation funds, specifically designed to modernize Spain's economy and ignite growth in overlooked sectors. This wasn't merely pocket change, it was a massive, strategically directed capital injection targeting critical areas like sustainable infrastructure, advanced digitalization, and burgeoning green energy initiatives. Consider the impact. Billions of euros meticulously allocated to de-risk future earnings for industry giants like OHL and Sasser in construction, or meticulously fueling the ambitious renewable energy projects of Iberdrola, which is actively expanding its offshore wind portfolio. In 2023 alone, an impressive €25 billion of these funds were deployed, accelerating vital projects that, without this catalyst, would have languished for years awaiting financing. Simultaneously, Spain's post-pandemic recovery proved surprisingly robust, particularly in its powerhouse tourism sector. Companies like Melia Hotels International and Amadeus IT Group saw a sharp rebound, with international tourist arrivals not just returning to, but exceeding, 2019 levels by Q3 2024, reaching a projected 85 million visitors. This remarkable resilience showcased an economic dynamism that many international analysts, often fixated on older metrics, had simply written off. Even specific regions, particularly the vibrant tech hubs around Valencia, with its Marina de Empresas ecosystem, and Malaga's burgeoning Silicon Valley, started attracting significant foreign direct investment and a growing community of skilled digital nomads, signaling a broader, previously underestimated shift in economic activity. The lesson here is that macro narratives can quickly become outdated, and focusing on underlying fundamentals, even in markets once deemed unloved, can reveal profound hidden strengths. So, who were the few bold enough to see past the gloom and into this quiet resurgence? But who was actually buying into this ghost market when everyone else was looking away? The answer points to a dedicated cohort of value investors, often dismissed as contrarians or even fools for accumulating positions in Spanish equities years before anyone else cared. These weren't speculative traders chasing headlines, they were deep fundamentalists, following principles reminiscent of Benjamin Graham and a young Warren Buffett. Buying quality companies when they are out of favor and trading demonstrably below their intrinsic value. Take Francisco Garcia Perez, often called the Spanish Warren Buffett, who consistently championed undervalued European equities, including those in Spain, through his firm, Cobas Asset Management. While the IBEX 35 wallowed, Perez and others like him weren't just guessing. They were meticulously scrutinizing balance sheets, cash flow statements, and management quality, conducting the kind of deep dive analysis that the broader market, fixated on perceived laggards, simply ignored. For instance, while most funds were chasing tech darlings in the US, Perez was building stakes in companies like Telefonica, TEF, SM, a telecom giant with significant underlying assets, or even smaller, overlooked Spanish industrials. Their investment thesis wasn't based on rapid growth projections, but on the inevitable reversion to the mean, the belief that eventually, underlying asset values would be recognized as economic conditions improved, especially with the strategic EU funds coming online. The lesson here is that patience and a disciplined focus on intrinsic value can lead to significant opportunities when others are driven by sentiment. But how did these dedicated investors manage to time their entry so effectively, seemingly seeing what no one else could? Yet, perhaps the most jaw-dropping revelation was that the market completely missed the fact that many of these Spanish companies weren't really that Spanish at all in terms of their earnings. For years, the market viewed companies listed on the IBEX 35 as primarily exposed to the Spanish economy, saddling them with a Spanish risk premium that artificially depressed their valuations. However, a deeper look reveals that giants like Banco Santander, BBVA, Iberdrola, and Repsol derive a substantial portion, often over 60% or even 70%, of their earnings from outside Spain. For instance, in 2023, Banco Santander reported that nearly 80% of its attributable profit came from outside its home country, with significant contributions from Brazil, Mexico, and the United States. This global diversification acted as a powerful shock absorber, insulating these companies from Spain's domestic economic fluctuations and offering multiple avenues for growth that were consistently overlooked by analysts fixated on local narratives. Consider Repsol, the Spanish multinational energy and petrochemical company. While headquartered in Madrid, its substantial oil and gas assets and exploration activities span across North America, Latin America, and Asia. This meant Repsol's profitability wasn't solely tethered to Spanish energy demand or regulatory changes. Its diversified portfolio of assets in places like Canada's heavy oil sands and various offshore fields provided a revenue stream largely independent of Spain's economic performance. The lesson here is that perceived geographic exposure can often be misleading. True exposure lies in where a company generates its cash flow. This critical mispricing, where global earnings power was discounted due to a domestic listing, created a massive valuation gap that patient value investors were able to exploit. But with all this hidden value, why did so many professional investors still fail to see it? The final shocker? The market's deep-seated cognitive bias about Spain's debt-to-GDP ratio blinded them to the real value in these companies. Despite headlines consistently highlighting Spain's sovereign debt as a concern, analysts largely missed a critical nuance. A significant portion of that debt was held domestically or by long-term European institutions, drastically reducing the immediate systemic risk for export-oriented companies. For instance, in 2022, while Spain's national debt to GDP hovered around 111%, Moody's still maintained a BA1 rating, recognizing underlying stability. The fixation on macro headlines and sovereign bond spreads meant analysts failed to differentiate between the government's balance sheet and the robust, independently managed balance sheets of its leading corporations. It was as if every company on the IBEX 35, from a global telecom like Telefónica, which derived 70% of its revenue from outside Spain in 2023, to an infrastructure giant like Ferrovial, with massive North American and UK operations, was being painted with the same broad brush of Spanish risk. This created a unique window. For years, the market consistently applied an all-Spain discount, effectively penalizing these firms for their nationality, not their global performance. Imagine buying shares in a company like Inditex, the parent of Zara, whose global reach is undeniable, at a valuation depressed by concerns about Spanish domestic consumption. As this perception finally corrected, the payoff was substantial. Some value holdings in diversified Spanish companies saw outsized returns of 200 to 300% between 2022 and 2026. The lesson here is that an over-reliance on broad macroeconomic narratives, without digging into company-specific fundamentals and revenue diversification, can lead to severely mispriced assets. So, what's the real takeaway here? This isn't just a story about Spain or a few savvy investors. It's a powerful reminder that the market, for all its sophistication, can completely miss the forest for the trees when collective sentiment and headline narratives override deep fundamental analysis. The lesson here is that while the crowd often follows momentum, true value is often lurking in the shadows, unloved and underpriced, just waiting for those patient enough to dig past the surface-level anxieties, especially when a company's actual revenue exposure defies its geographic listing. It's about recognizing that hidden strengths, like international diversification, can completely shatter a broad market discount. Have you ever identified a company the market was completely mispricing due to a similar cognitive bias? Drop your story and the outcome in the comments below, I'd love to hear it. And if you want more deep dives into how some investors find these overlooked opportunities, hit that subscribe button. Next, you'll want to watch my video breaking down how Cathie Wood's ARK Invest navigated the 2022 rate hike cycle, focusing on their shift into underappreciated sectors. It's the perfect companion to this story.